Hello and welcome students to my YouTube channel. In the last video lecture I explained you question number 10 of chapter number 6, that is retirement or death of a partner. Now in this video lecture I am going to explain you question number 13 of the same chapter, that is on page number 270 of your textbook. So let us read the question first of all. L, B and W are partners of a firm sharing profit and loss in the ratio of 2:2:1. It means the old profit and loss sharing ratio of three partners, that is L, B and W, that is 2:2:1. Balance sheet of the firm on 31st March 2016 was as under. Now first of all let us look at the old balance sheet that is given to you in the question. Liability side, that is capital of all the three partners. So you can see already I have prepared on the board, that is revaluation account, partners capital account, cash account and balance sheet after retirement. So let's do the posting together with the transactions. First of all there is the capital account of three partners. So first entry on the partners capital account credit side, that would come by balance brought down 20,000, 12,500 and 5,000. Then afterwards general reserve is given to you 5,000. No any adjustment related to general reserve is there. So as it is, we have to distribute the accumulated profit amongst all the three partners in their old profit and loss sharing ratio. What is the old profit and loss sharing ratio? That is 2:2:1. So 5,000 that will be distributed in 2:2:1. So you can see on the partners capital account credit side, second entry that I have written by general reserve 2,000, 2,000 and 1,000. That is in the ratio of 2:2:1. Then afterwards creditors and outstanding expense, no any adjustment is there. So as it is directly in the new balance sheet after retirement, we'll do the same entry as it is without any change. So you can see creditors on the balance sheet, new balance sheet after retirement, I have written creditors value as it is 20,000 and outstanding expense also as it is, that is rupees 3,000. So completed the liability side. Now moving on to the asset side. Asset side, first entry that is given to you, that is goodwill. What is the value of goodwill that is given to you? 8,000. Now this is the old goodwill before the retirement of the one of its partner. So this goodwill is old goodwill that is to be distributed amongst all the three partners including the retiring partner in their old profit and loss sharing ratio. So you can see old goodwill, already I have told that it will be always debited in partners capital account. Okay, so debit side of partners capital account, first entry that I have written to goodwill that is distributed in the ratio of 2:2:1. So that comes to 3,200, 3,200 and 1,600. Then afterwards building, that is 37,000. Now related to building there is an adjustment given to you. Refer the adjustment number. First one, market value of building is rupees 50,000. What is the value given of building in the old balance sheet? That is 37,000. Now the new value or the market value of building, that is to be maintained at rupees 50,000. So the value of building has increased by rupees 13,000. So due to increase in the value of asset, profit will occur to the firm, and if profit occurs it will be recorded on the credit side of revaluation account. So you can see on the credit side that first entry I have written by building, that is rupees 13,000. That is this much profit has occurred due to increase in the value of building. And simultaneous second entry, that is on the asset side of balance sheet, new value of building that I have written, that is 50,000. Okay. Then afterwards debtors. In case of debtors, that is value rupees 13,000. No any adjustment is given. So as it is debtors value that I have written rupees 13,000. Then afterwards in case of stock that is given to you 5,500. Now there is an adjustment, second adjustment related to stock. Book value of stock is 10% more than its cost. Stock is to be recorded at its cost. Book value of stock is 10% more than its cost. It means whatever the value that is given to you in the old balance sheet, that is always the book value, and book value is 10% more than its cost. And at what price we have to record the stock? That is at the cost price. So we have to find the cost price of stock. Okay, so I'll show the working note to you. Suppose the cost price is 100 and 10% more, it means 10 rupees. So book value that would come to 110. Okay, so if the book value is 110 then cost price is 100. So if the book value that is given to you in the old balance sheet, that is 5,500, then what would be the cost price? By doing the cross multiplication, you will get the cost price of stock, that is rupees 5,000. So in the new balance sheet, we have to maintain the value of stock at cost price, that is rupees 5,000. So instead of 5,500, we have to show rupees 5,000 only. So if there is decrease in the value of stock by rupees 500, so that decrease in the value of stock, that is loss for the firm. So it will be recorded on the debit side of revaluation account. So you can see debit side first entry that I have written to stock rupees 500, and the simultaneous second entry, that is the new value of stock, that is rupees 5,000. Okay, so we have to find the cost price, because at cost price we have to record in the new balance sheet. Then afterwards, after stock, last entry, that is cash. Now what is the balance of cash that is given to you? 2,000. So that 2,000, that is the opening balance. I have separately prepared cash account. So to balance brought down, first entry, that is always debit balance, so 2,000 the first entry. Now all the entries that we have done from the old balance sheet. Now referring the adjustments, W retired on 1st April 2016. Now out of the three partners, L, B and W, the third partner, that is W, is retiring. Market value of building, first adjustment already we have done. Second one of stock also we have completed. Now the third adjustment. Personal expense of W, rupees 500, was debited to P&L account. Now personal expense means drawings of any particular partner. Now drawings of rupees 500 of W, by mistake it was debited to profit and loss account. It means it was considered as loss of the firm. Actually, it was not loss of the firm, it was the personal expense of any particular partner. So now we have to rectify this entry. What would be the rectification entry? We have to give the correct posting. Personal expense means drawings. So we have to show drawings in that particular partner's capital account. You can see the second entry that I have written. Drawings will always be debited and capital will always be credited. So on the debit side, that I have written two drawings in the column of W, that I have written rupees 500. And the second entry, we have already discussed that in case of adjustment, always there will be two effects. The first effect, that is two drawings, that is the correct effect we have done, that is rupees 500. Now to rectify the mistake, what mistake we have done? We have debited to profit and loss account. So we had considered it as a loss or an expense, but actually it is not a loss or an expense for the firm. So to rectify, we have to give the opposite effect of it. So instead of loss, now we have to consider it as a gain or profit for the firm. So you can see on the credit side of revaluation account, the second entry that I have written, that is by personal expense of W, that is rupees 500. So you can see two effect. Already we discussed that adjustment is having two effect, one debit effect and the other credit effect. So the debit effect that I have given, you can see on the debit side of partners capital account, and the credit effect on the credit side of revaluation account. So always two effect of any adjustment. Okay. Now fourth adjustment that is given to you, that is of goodwill. Goodwill of the firm is valued at rupees 80,000. Now what is the value of goodwill that is given to you? That is rupees 80,000. Now goodwill value that is given to you 80,000, that is the goodwill of the entire firm. Out of that we have to find the share of goodwill of the retiring partner. So 80,000, that is the goodwill of the entire firm. So out of 80,000, what is the share of the retiring partner? That is 1 by 5, because 2 is to 2 is to 1. So 80,000 multiplied by 1 by 5, that would come to 16,000. Now that 16,000 is to be distributed amongst the continuing partners in their gaining ratio. So we have to find the gaining ratio over here, but one adjustment related to gaining ratio has already been given to you. So gaining ratio we don't need to find because it is given in the adjustment. For that, look, fifth adjustment, L will gain 5 by 40 and B will gain 3 by 40 from W's share of profit. It means the gaining share of the continuing partners that has been given to you, that is 5:3. So 16,000 that you will be distributing in the ratio of 5:3. So 16,000 multiplied by 5 by 8, that would come to 10,000, and 16,000 multiplied by 3 by 8, that would come to 6,000. So it will be distributed in the ratio of 5:3 between the continuing partners, that is L and B. So what is the journal entry? Again revising, that is continuing partners capital account debit to retiring partners capital account credit. Now who are the continuing partners over here? that is L and B, and the retiring partner, that is W. So containing partners capital account debit. So on the debit side you can see I have written the name of the opposite party, that is 2W's capital account, and in the column of L that is 10,000, and in the column of B that is rupees 6,000. That means containing partners capital account debit to retiring partners capital account credit. You can see 10,000 and 6,000 that I have written on the credit side of retiring partners capital account. And name of opposite party, that is by L's capital account 10,000 and by B's capital account credit, that is rupees 6,000. So this we have done the posting of the new goodwill of the retiring partner. Now the last adjustment that is remaining, and that is very important, amount due to W is to be paid in cash. Now whatever the difference comes of the retiring partner in the partner's capital account, that amount is to be paid in cash, and the same amount will be brought in cash by L and B. Now whatever amount that is to be paid to the retiring partner, that same amount will be brought by the containing partner in cash, okay, in such a manner that the capital may remain in their new profit and loss sharing ratio in the new form. Now how much share each partner will contribute of the total share that is to be given to the retiring partner, that will be decided accordingly to maintain the new capital in the new profit and loss sharing ratio. On that basis we have to decide how much cash will be brought by the containing partners in order to pay to the retiring partner. Okay, so for that, first of all we have to close the revaluation account. Okay, so you can see in the revaluation account credit side there are two entries, so total that came to 13,500. Difference that comes on debit side, there is only one entry, so subtracting it, the profit that would come to 13,000. Now this profit will be distributed always in the old profit and loss sharing ratio, that is 2:2:1. So that has been coming to 5,200, 5,200 and 2,600. So simultaneous second entry that will be on the credit side of partners capital account by revaluation account, that is 5,200, 5,200 and 2,600. Now after doing the posting of the revaluation account in the partner's capital account, now we have to find the difference in the partner's capital account. So first of all we'll find how much cash is to be given to the retiring partner. So you can see the retiring partner is W. Total of the credit side that comes to 24,600. So difference that is after subtracting these two entries, difference that is coming to 22,500. It means W is to be paid rupees 22,500 at the time of his retirement. Okay, now this 22,500, that much amount of cash will be brought by the continuing partners in such a way that they will maintain their closing capital in the new profit and loss sharing ratio. So first of all we'll find the difference. First we have found the cash, how much to be brought, how much to be given to the retiring partner. Now we'll find the difference of the capital or the closing capital of the remaining two partners. Okay, so over here you can see I have done the working note over here, that is of L and B. Now in case of L, first of all you don't consider this value of cash account because this we have found out. So before that 12,500 plus 2,000, that would come to 14,500. 14,500 plus 5,200, that would come to 19,200. Okay, so in case of in case of B, that would come to 14,500 plus 5,200, that would come to 19,700. So 19,700 minus 9,200, how does 9,200 came? That is 3,200 and 6,000. So difference that would come to 10,500. Now how does 10,500? Again I am explaining. Before the entry of this cash account and before the entry of this closing capital, what is the total coming of B? That is 12,500 plus 2,000, that would come to 14,500. 14,500 plus 5,200, that would come to 19,700. From 19,700, the two entries, that is of goodwill and W's capital account, that is of new goodwill, these two entries will be subtracting the remaining, that is 9,200 will be subtracting remaining balance, that would be 10,500. Now in the same way we will find the closing balance of the one of the continuing partner, that is L. Okay, so in case of L, you can see 20 plus 20,000 plus 2,000, 22,000, 22,000 plus 5,200, that will come into 27,200. You don't have to consider this entry of cash. Okay, so 27,200. See, I have written the working note, that is 27,200 minus what is the debit entry, that is 3,200 plus 10,000, that would be coming to 13,200. Don't consider this again closing capital. This we have to found later on. So 13,200. So here in the working note you can see 27,200 minus 13,200. Difference that comes closing capital. Before finding the closing capital and before finding the amount to be paid to the retiring partner, the closing capital that is coming to 14,000 for L, and for B that is coming to 10,500. So total capital that comes of L and B, that is 24,500. Now 24,500, that is closing capital of the two partners, that is containing partners L and B. And how much amount is to be paid to the retiring partner, that is 22,500. So total capital value, that would be 47,000. Okay, so total capital, that is 47,000, is to be distributed amongst the continuing partners in their new profit and loss sharing ratio, because it has been told in the last adjustment that the amount to be paid to the retiring partner will be brought by the continuing partners such that they will maintain their new capital in new profit and loss sharing ratio. So first of all, we have found the new capital, and that is to be distributed in the new profit and loss sharing ratio. Now new profit and loss sharing ratio is not given to you in the question. So we have to find that new profit and loss sharing ratio. For that you can see the working note that I have shown over here. Students, you are knowing the formula of gain, that is new minus old share. So from that formula I have found out the new ratio, that is new profit and loss sharing ratio is equal to gain plus old share. Okay, so new ratio, that would be of only the continuing partners, that is L and B. Now what is the gain, that is also given in the adjustment, that is 5 by 40 and 3 by 40 plus old share, that is 2 by 5 and 2 by 5. So by doing the taking the LCM, it would come 40 over here. So 5 8s are 40, 8 2s are 16. 16 plus 5 would come to 21 by 40. And in case of B, that would be again 5 8s are 40, so 8 2s are 16. 16 plus 3, that would come to 19. So 19 by 40. So the new profit and loss sharing ratio, that is coming to 21 is to 19. Now whatever the new capital that came of these two partners, that is L and B, that is coming to 47,000. Now that 47,000 is to be distributed in the ratio of 21 is to 19. So you can see I have written over here two balance carried down. You distribute rupees 47,000 in the ratio of 21 is to 19. It would come to 24,675 and 22,325. You can verify the total of these two should come to 47,000. Okay. So after finding the closing capital that we have maintained in the new profit and loss sharing ratio. Now whatever the difference comes, that will be the amount of cash that they will be contributing to the retiring partner. Okay, so now we have to find the difference. Difference will be coming on the credit side because the total of debit side is more now after finding the closing capital. So on the debit side, total of L's capital, that would come to 37,875. 37,875, difference that is coming to 10,675. So that amount of cash will be contributed by L to the retiring partner, that is W. So here you can see I have written by cash account because that much amount of cash he is bringing in order to give to the retiring partner. So by cash account, that is 10,675. In the same way for B, total that comes on debit side 31,525. 31,525, difference that comes to 11,825. It means the total of this two, again you can verify, it would always come 22,500. Okay, so that much amount each partner is contributing in order to pay to the retiring partner. So cash account, so simultaneous entry second would be posted on the debit side of the cash account. Here it is on credit side. So on the cash account, it will be on the debit side. You can see on the debit side that I have written to L's capital, that is 10,675, and to B's capital, that is 11,825. And over here to cash account, that is 22,500, because that much amount is to be paid to the retiring partner. So simultaneous second entry, that is on the credit side. So by W's capital account, that is 22,500, and that much amount of cash is contributed by L and B. Total of this two, that would come to 22,500. This much amount will be paid, and this much amount will be brought by the continuing partners in order to pay to the retiring partner. Okay. So we have found the closing capital, we have found how much amount is contributed by each partner in cash to pay to the retiring partner. Now we'll close the cash account. You can see close cash account opening balance, that is 2,000. Same amount will remain in closing balance, because 22,500 whatever is to be paid to the retiring partner, same amount is brought by the continuing partner. So opening balance and closing balance will remain as it is, that is rupees 2,000. So in the new balance sheet I have written the value of cash, that is rupees 2,000. Okay. Now after completing, already we have discussed all the entries in the old balance sheet. We have done the posting in the new balance sheet, so no any entry or adjustment is remaining to be posted in the new balance sheet. So now we'll do the total of the new balance sheet. You can see total on both the sides, that is coming to 70,000, 70,000. It means our answer is correct. So in this sum, the main important point is how to find the closing capital of the continuing partners, and on that basis we'll find how much amount is to be paid to the retiring partner by each of the continuing partners. So that was a important point in this sum. Do revise it again by keeping your textbook together while referring the video lecture. That's all for today, students. Goodbye, take care, stay blessed.